Hello and welcome. In this month's on-demand webinar, OJM Group Director of Wealth Advisors, Bob Peelman, CFP, provides an overview of some common investment products found in many portfolios. He covers the basics of stocks, bonds, ETFs, mutual funds, and REITs, and discusses the pros and cons of these investment vehicles. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books, including our newest title, Wealth Management Made Simple. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Hello, I'm Bob Peelman. One of the things we talk about is investment terminology. Sometimes in our profession, I feel like we take for granted what our clients may or may not know about the markets. And specifically, sometimes, what exactly are the products that you might be owning? Now, there are many complex investment products out there. And many times, the more complex they are, the more skeptical, personally, I become and our firm becomes of them, because there may be layers of fees and complexity that's not necessary. But there are some valuable ones as well that might be a little bit more complex than you may be used to. But today, I want to talk about some common investment vehicles that clients, investors typically own. Those would be stocks and bonds. And the types of ways to own stocks and bonds outside of the individual securities, such as ETFs, which are exchange traded funds, and mutual funds, and then REITs, which are real estate investment trusts. And so we're going to talk about these today in a little bit more detail. We're going to continue a series with our podcast series on more complex vehicles, more detail about these specific products as well. But today we'd like to talk about how these work, what some of the benefits, what some of the negatives are of these products, and how they may work for you in your portfolio. So let's start with stocks and bonds. Most investors feel like they have a pretty good handle on what these two investments are. So a stock is simply an ownership in a corporation. You're an owner, so you may own only one share of Apple, but you own Apple. And so you are a vested owner in that company. This gives you voting rights. So there are important votes, whether it be board of directors or different types of policy that the board wants to make that they want to put to a vote to shareholders. This gives you the right and a voice when you own stock. Historically, stocks will provide higher rates of return. So over time, you would think you would average between 9 to 11% in stocks over a 10, 20-year period of time. With that, though, comes more risk. Stocks, because you're an owner, you're subjected to all types of risk. There could be a business risk inside of the company. One of the examples I think back to is clients who may have owned BP oil, for example, and then there's the oil spill in the Gulf of Mexico several years back. That was a risk, owning that individual company. Instead of owning, say, the energy sector, you may have had that one company. Or obviously more notable, things like Enron. So if you have corruption at the board level or CEO level, any of those types of things. So with the higher historic rates of return in the stock market comes significant risk, and you take that on as an owner of the company. Bonds also provide some growth, but the risk is historically lower. This is something you would own for income generation, but also to lower volatility in a portfolio, and I'll show that on a slide here momentarily. But the purpose of bonds, it's almost as if you're the bank in a corporate bond structure. A corporation, say Procter & Gamble, is looking to do a project, research and development, and they're going to issue bonds, and the bonds may mature in 5 years. they're going to pay a rate of return to you. You're the banker. You give them $100,000 of your money. They're going to pay you 2% over the next 5 years with a guarantee of your principal money coming back to you at maturity. Now, the risk is default risk. Obviously, if the company goes bankrupt, then you are going to fall in the line as a secured lien holder. You're going to fall in line to receive funds, but you're likely not going to get much of your principal back in that situation. Now, there's different classifications of bonds, from their credit ratings all the way up to triple A, down to junk bonds, triple C below. But again, this is not perfect. If you remember back 2008, 2009, during the financial crisis, on a Friday afternoon, Lehman Brothers is a AAA rated credit, and by Monday they're out of business. So things can move very quickly. Sometimes it can be difficult for these credit agencies to get a true understanding of what's happening with inside of these companies. So certainly there's risk with bonds, but we would say the risk is lower, and the risk comes in the way of default, interest rate risk, liquidity, some of those types of things that you can manage in the way that you handle bonds. So stocks and bonds in a way are similar, but in a way are different. They are at the individual level for a company. So a company can issue bonds, and certainly they're publicly traded, they have stock. But think of yourself as an owner, as a shareholder or stockholder, and more as a bank when you are working in a corporate bond structure. I like this chart from Ibbotson going back to 1926. This one is particularly through 2016, that shows stocks, bonds, T-bills, and inflation. So you get a sense for how the rates of return look for each of these instruments. And obviously small companies are higher risk on the stock spectrum, so they've averaged a little over 12% during this period of time. Large cap stocks, say the S&P 500, around 10%, government bonds 5.5%, treasury bills 3.4%, and inflation 2.9%. So if you wanted to be in the most quote unquote risk-free bucket of money, that would typically be T-bills, treasury bills historically. And you're just going to barely outpace inflation. So long term, it's not a very great investment. There's different periods of time where we've seen higher interest rates where T-bills made sense. Certainly right now is not one of those, but you can see that investment is going to typically barely outpace inflation. Government bonds provide a pretty nice return of around 5.5%, but again, you have lower risk, as we talked about. So clients that are nearing retirement or in retirement that need income and lower risk, this can make a lot of sense. And then a stock portfolio, large cap stocks, small cap stocks, there's certainly a variety of international, emerging markets, different sectors, but this gives you a flavor for the types of performance. But those returns come with obviously bigger swings in the market. Here's bond market performance. So if we want to dive a little deeper into that bond market performance that we looked at on the previous page, this goes back from 1986 through 2016. You can see, again, treasury bills, the most liquid, the most typically viewed as the least risk on the bond market food chain, provides the lowest return of around 3.3%, again, just outpacing inflation. But high yield corporate bonds around 8.6%. And now these are, more of that junk bonds, lower credit quality companies that are going to have to pay you a higher rate of interest in order for you to want to own their bonds. Government bonds 8.4%, corporates around that 8.4% number, and then municipal bonds, which are tax-free typically at the federal and state level, provide 6.9%, and that can be very advantageous if you are retired, nearing retirement, live in a high tax state, and are in a top marginal tax bracket. Municipal bonds are very attractive and can be. So this just shows you a little bit about what to expect as a bondholder. I really like this chart going back to 1926 about the relationship between bond prices and yields. So they're inverse of each other. Obviously, you can see by looking at this chart that bonds don't come without risk. And one of the big risks with bonds, as a holder of bonds, is when interest rates rise, the price of bonds go down. And the longer your maturity is on your bond, the more volatile that bond will be with interest rates. So you can see here, we would expect to continue to be in an environment where yields are going to go up, but that hasn't been the case since the early 1990s, where yields have been going down. You see this in your low mortgage rates, the 0% cars over time you've been able to purchase. And now we're in an environment where the economy has been doing well, and the Federal Reserve is beginning to tighten their monetary policy, raising rates. And by doing so, you're going to start seeing these yields begin to tick up. And it's already happening year to date. At the time of doing this podcast, as of May 7th, year to date, corporate bonds were down a little over 3.5% for the year. So bonds can go down in price. And so the bond prices will go down as rates go up. So one of the things you have to manage as an owner of bonds is the maturities. You want to have a laddered bond portfolio to make sure that you are trying to mitigate the risk of interest rates as much as possible. So adding a bond allocation to diversify, I think this is a really neat graph here, because if you looked at a portfolio from 1970 to now, and on the left you had 70% stocks and you kept the 30% in cash, so 70-30, you would have achieved a return of 9.7%. But your standard deviation, which is a measure of risk, meaning the higher the standard deviation, the more risk in your portfolio, so you want that number to be lower, is 12.1. A 55 stock, 40 bond, 5 cash allocation would give you the exact same return, but you can see a much lower standard deviation. So that's really the holy grail when you're building portfolios, is you want to maximize the return for your clients, maximize your return as an investor, but you want to do so with the lowest possible risk, right? It's much easier to return 10, 11, 12% if you put 100% of your market in emerging market funds, because they may go up 50%, they may go down 50%, but typically that's not a risk most people are willing to take. So you really want to optimize the trade-off between return and risk. So we talked about owning stocks and bonds, but there's a variety of ways to own stocks and bonds. One of the more popular ways now is exchange traded funds, which is a basket of securities. So this is an open-ended investment company that is going to offer a proportionate share in a portfolio of either stocks, bonds, or other types of securities. Most ETFs are index-based funds, and they want to mirror some type of underlying index. So a common one to think about maybe the S&P 500. So if you were to buy the S&P 500, you're going to mirror the weighting and the exact positions in the S&P 500 and perform with a small fee inside of there and achieve that return. Exchange traded funds are great because they provide diversification. So the example I mentioned before of an oil spill or one particular company. Another one to think about now is Facebook. Some of the things that they're having to respond to with Congress about privacy rights and protection is, if you own the technology sector, you're certainly going to own Facebook inside of there, but you're going to own Amazon, you're going to own Google, you're going to have Netflix, you're going to have a variety of companies that's going to spread that risk. So if you're a firm believer in innovation and technology and you want to own technology, maybe a way that fits your risk profile better than an individual stock might be to own a ETF in technology, as an example. So it's going to provide more diversification. It's flexible, so ETFs can be bought and sold just like individual stocks. It allows investors to place stop limit orders. So if you have a price that you're willing to go down but no further, you can put that in place to protect you. You can buy and sell on margin. So if you have a taxable investment account and you like to utilize margin in your portfolio, you certainly can do that. which is a little bit different than what you can do with other types of vehicles. And then the tradability is great because ETFs are traded all day when the market's open on the exchanges, so it provides a little bit more of liquidity for investors. If you compare ETFs with, say, the index or index mutual funds or actively managed mutual funds, you can see here ownership of the ETFs are purchased on the exchange. Mutual funds is directly from the fund, so you're purchasing from the fund company. ETFs are typically passively managed, although now we're starting to see more and more actively managed ETFs. Again, does it have a manager or a process in place to select securities? But typically index funds are passive, and then mutual funds are usually actively managed. Pricing, again, you can do limit orders, short selling, margin. They're traded throughout the day. With index funds and mutual funds, you get your net asset value price once per day at the end of the market close, and they may require a minimum investment to get in. Cost, they all have ongoing management fees, but typically index funds and exchange traded funds are far lower than an actively managed mutual fund. So an actively managed mutual fund, you may pay what we call an expense ratio or a fee inside of that mutual fund. It can be 0.5%, it can be 1% or higher. With ETFs, you may just have some trading costs at your brokerage firm, but the underlying fee inside of there is going to be pretty low. It could be as low as 10 basis points, 5 basis points, depending on the fund family that you pick. Transparency is great because the underlying holdings inside of ETFs are daily. So you can drill down and see what is being owned in my exchange traded fund, and you can see that on a daily basis. With mutual funds, index funds, they are required on a monthly or sometimes quarterly basis to disclose that. So you may go a period of time and not really know, does my fund own Facebook, or did they sell Amazon? What have they done? Sometimes they'll communicate that to you in shareholder letters, but you may not know that. Taxes. Fund shareholders generally are not affected by tax liabilities in ETFs, where in funds you are. So the best way to describe this is, as an exchange traded fund, if you sell the investment, you are required to pay capital gains if you have gains. But in a mutual fund, you may not actually sell your mutual fund, but all of the buying and selling that's happening in there, they may generate a 1099, and you may have to pay capital gains tax pro rata for your shares without actually you selling anything. So typically mutual funds, not always, are better off. We want to keep them in more of the tax deferred vehicles. Qualified plans, retirement accounts are typically the place you want to be for those. So we come over here to potential advantages of ETFs, intraday trading. Again, I talked about ETFs are traded between the market hours of 9:30 and 4. So at any moment during the day, something's happening, you want to sell, you're able to get out of the market if you need to, or get in if there's an opportunity. With mutual funds, unfortunately, they're priced just at the end of the day. So market goes down 1,000 points during the day, or something's going on, you're going to be in there until, even if you sell it during the day, you're gonna be there and get that 4 o'clock closing price. So that's a big disadvantage to the mutual fund structure. Again, ETFs are a very fast growing investment vehicle. You can see here, they've just been growing since 2005. There's now a big variety of the types, so it's not just US stock ETFs. You can see in the mid 2005, 6, the number of ETFs out there were pretty small, and most of them were your basic US stock index funds. Now there's a variety of commodities, alternative investments, bonds, subsectors, international US stocks. So in the ETF space, there's an ETF for just about anything that you would want to invest in. So as we transition to the last investment I want to touch on today is real estate. So what is a real estate investment trust? So to qualify as a REIT, a company must have the bulk of its assets and income connected to real estate investments and must distribute at least 90% of that income to shareholders annually in the form of dividends. So real estate is a great way, and there's commercial real estate, there's residential real estate, there's sectors of real estate. You can own the healthcare sector, medical office building real estates. apartment building real estate. But essentially, it's going to allow you as a shareholder to own real estate without all the work of owning real estate yourself, right? So no management company for you to hire. You don't have to be a landlord, collect rents, handle maintenance. So it's a way for you to say, I like real estate, I want to own real estate, but I want to be very diversified in the way that I own real estate. And I want to maybe get a nice dividend. Now, there's a variety of ways to own real estate, public real estate, private real estate. We give you some examples here of the different types of non-traded REITs, exchange-traded REITs. Exchange-traded REITs are just like ETFs. They're on the exchange. They provide all the benefits we discussed about being able to get in and out of them, the liquidity. The one issue with public REITs, as we talk about them with our clients, is the diversification. While it does provide some diversification away from traditional stocks, typically publicly traded REITs will move pretty correlated with stocks. So, the market's down 500 points that day, your public REIT is going to move pretty close in unison. So while it might provide a nice dividend, it doesn't necessarily always give the diversification benefits that we like to see. Non-traded REITs will. They are private in nature. They have a variety of different types that you can have. Some of them, you may own for 2, 3, 4 years before they may try to exit and have a public offering for the REIT. But a private REIT's going to provide a little bit lower correlation to your traditional investment vehicles. It's also going to provide income right around the same, sometimes higher level of dividend income. And you're typically going to get a little bit more in the way of expert management at the private level. Now, they all come with fees. Obviously, we recommend for our clients to use a registered investment advisory firm like ours to purchase these types of investments, which don't come with the upfront commissions that you would see being sold through a brokerage firm, which can get very expensive and doesn't make these investments as attractive. So that's something we sit down with our clients. We talk in detail about, do these make sense? How would they work for you in fitting in your overall pie? So lastly, I just want to talk about how we utilize those investments here at OJM. So we first start with understanding your risk. So again, it's very difficult for us to say how are we going to optimize your comfort level of risk unless we really drill down and identify that. We've got a pretty unique way of doing that by putting a risk number to you and your family on a scale of 1 to 99, 99 being the most risk. And there'll be a series of questions with the next question we ask, which is going to be a little bit different than the question we asked based on your answer. So we start with that. And then we want to understand, what are we saving for? What are we investing for? Is it retirement? Is it a purchase of a vacation home? What's our time horizon for this money, and how long can we expect it to be in the markets? Then we think about, based on those two things, what's a strategic or neutral allocation? Meaning, if the economy was neutral, we didn't have an opinion, and we weren't going to change anything for the next 30 years, how would we build a portfolio for you? And then we take that and we say, okay, well, what are the fat pitch opportunities, things right down the middle of the plate that we can hit a home run with, and shift that strategic allocation away from neutral to take advantage of some fat pitches. And we'll tweak your allocation based on what we think over the next 5 years are those opportunities. Great example right now is, our clients have far less in corporate bonds, government bonds, than they might based on their risk tolerance. But again, that's a function of, we think we can put your money somewhere else and avoid interest rates rising and take advantage of that for you as a client. And again, our preferred investment vehicle methods are more of the ETFs, index funds, low cost variety. We do implement some actively managed mutual funds if the manager performance is so successful that it warrants paying that extra fee to them. But typically we're going to use a lot of sector funds, index funds to accomplish what we want to do in building out a portfolio. Thanks for watching.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. we would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.